Hi, good evening. We have Shriram Ramanathan, Head of Fixed Income, L&T Mutual Fund, joining us to give a view on fixed income outlook. Hi, Shriram.
Hi.
So the first question here is, RBI is raising rates, Fed is raising rates, we are seeing tightening of global liquidity. As a fixed income fund manager, are you worried with this scenario, and how should a fixed income investor position himself?
Definitely, all the factors that you mentioned are reasons why we at L&T Mutual Fund have been worried and cautious since July last year. And which is why rates over the last 1 year have moved up significantly, almost 150 basis points with the 10-year GSEC now pretty close to the 8% level. So all these negatives, I would say, are to a large extent priced in, which is why now I think investors need to look at it in a more balanced way. It does not, to our mind, make that much sense to be extremely risk averse and keep yourself invested only in liquid funds, etc. I think now it's a question over the next 2-3 years, if you ask me. I think it's a question of going a little bit further out onto the yield curve, getting a good carry. I think the accrual part is very attractive. Keep duration-related risks relatively low, but at the same time try and maximize on carry. I think that's the way fixed income investors should look at mutual funds, fixed income mutual funds over the next couple of years.
So you mentioned the point on duration. Do you think the valuations are attractive because the spread between the 10-year benchmark GSEC and the repo rate is nearly 160 bips, which was in the during the 2013, more than the 2013 taper tantrum. So is it attractive from a duration play?
I think there are different ways to look at it. And I think a lot depends on the investment time horizon that the investor is looking at. Like I mentioned, typically we have had almost 3 rate hiking cycles over the last 15-17 years in India. And each of the times before the first rate hike or at the time of the first rate hike itself, markets discount the future trajectory. So to a large extent, the current level of 10-year government security at 8% kind of discounts at least another 2 to 3 more rate hikes over the next year, and which to our mind is a fair representation of the market. The real thing is, from a duration perspective, does it make sense to add that duration, and are you going to make capital gains because of that duration? And that's where I think, at least over the next 6 months to a year, we still think there are things evolving. Core CPI is still fairly high, closer to the 6% level. On the external front, our current account deficit with the recent trade numbers that have come out also indicate that there is that element of rebalancing that is required as far as our external accounts are concerned, because basic balance, if you look at it, current account deficit plus the FDI is still fairly short, which means we are reliant on portfolio flows to become flat on the balance of payment side. So to that extent, which is why our reliance is more on carry as a real way to play out the coming year, 2 years, and not necessarily that go long on duration and that you're going to make a lot of capital gains. Having said all of that, the other point to mention is if you really take a step back and look at it from a very long-term perspective, rates at 8% are fairly good. Almost 75% of the time, interest rates have been in a 6 to 8 quarter zone. In fact, we had done a small study recently to just check over the last 15 years. Whenever 10-year GSEC has been above 8%, what has been the coming 3-year, 5-year rolling returns? And actually, the results are fairly good. 3-year returns on an average are like 9.1% on the CRISIL Gilt Index every time the 10-year GSEC has crossed 8%. And even on a 5-year perspective, returns are like 8.5%, 8.6%. So there is a merit to look at it from a long-term perspective. Rates are not bad, they are good. But is there a near-term reversal which is going to add to capital gains? Probably not. Last thing that I would want to mention is there are opportunities on the duration side, but that more from a long-term savings perspective. A lot of us invest in tax-free bonds. Tax-free bond yields are still very low. They are at 6.3, 6.4%. Compared to that, the way taxable bonds, the bonds that mutual funds invest in, have moved up almost 150, 170 basis points. So the spread between the two is now at almost 2.3, 2.4%, which used to be 100 basis points a couple of years back. So maybe one idea from a duration perspective for investors who have a lot of investments already on the tax-free bond side could be to start allocating a little bit to longer dated AAA rated bonds to take advantage of this, because on a tax adjusted post expense basis, our sense is long dated bonds from a mutual fund perspective, can actually outperform what you have as tax-frees. So that is one long-term opportunity. But from a near-term, from a 1 year, 2 year perspective, I think carry and accrual is probably the way to go.